Has the crazy rise in interest rates made you wonder if you can even afford to buy a new home? Well, I was interviewed last week by CBS Money Watch about this very topic. So let's take a deeper dive into what's happening in the market and how you should look at your own situation so you can make a smart decision for yourself and for your family. I'm Victor Currie here with the Unvert Group at Douglaselliman Real Estate, covering Los Angeles and Orange County markets. And today we're going to talk about an issue that affects everyone everywhere, not just here. That's affordability. So whether you're shopping for a home right now or renting right now, the fluctuations in the market still affect you. So the big question right off the bat, does it make sense to buy right now? In the current latest housing data that came out as we were recording, actually, if you were going to want to buy a medium price home in California at the prevailing interest rate right now, and remember, that's with 20% down, your mortgage payment would be $4,332 a month, plus property taxes, plus upkeep, plus utilities, and maybe some HOA dues tossed in there as well. Loan payments are up by 109% since the pre-pandemic days when you factor in both higher property prices and higher interest rates. So again, should you be considering buying? Well, the answer, from my perspective, if you can afford it in the current times, is yes. And before you get tempted to say, Victor, you're a realtor, and of course you want me to buy a house, that's how you make your money. Yeah, that's true. But it's not why I think you should buy a home if you can afford it. Historically, real estate values rise, and it's a hedge against inflation. There's also tax benefits, though if you're in California like me, you probably use up your state and local tax deductions pretty easily. So talk to your accountant about your own personal situation. But let me give you a personal story. We bought a townhouse in Newport Beach back in 2006 for $850,000, close to the top of the market in the last run-up of prices. And when the market crashed in 2008, it lost about $250,000 in value. And that crash was the slowest price recovery time in modern real estate history. So jump ahead 7 years and we had things changing in our lives. And so we sold that home. And even though the market had previously crashed, we still made a slight profit, had lived in a great neighborhood, had a stable monthly house payment that didn't increase like a rental would, and had the tax write-offs along the way. And that was all with interest rates that were right about where interest rates are now. Now, do I wish we still had that place? Well, you bet I do, because it's now worth about $1.5 million 7 years later. We sold that one just before I got into real estate business, and knowing what I know now, we still have that place as a rental. Anyway, the way to look at real estate prices is basically draw a graph. And if you're listening in the audio version of this, picture a line going up on a 45-degree angle, and that's the value of residential real estate property averaging out over a 30-year period. Now draw a squiggly line back and forth across that one, and that's kind of the one representing what real estate does in the short term. It goes up and it goes down, it goes up and it goes down, but it's still following that long-term appreciation line. It's that long-term line that keeps going up that it shows why the real estate market makes sense for most people if they can afford to get in. And we'll get into how to afford property in other videos and podcasts. So hit the subscribe button and we'll get to those later. Now, I'm the first person to say that if you don't know where you're going to need to live in the next 2 or 3 years due to possible work or life changes, you need to think long and hard about whether the home you're looking at now can carry itself as a rental property if you need to move and the market at that time doesn't lend itself to your selling the property. But I'd even go as far as to say if you're in the high-priced markets like we're in, and saving that down payment feels like an impossible goal, it might be worth looking at a lower priced area and maybe even in another state, just so that you're invested into the market in the long haul, even if you keep renting here for now. By the way, there's a lot of alternative programs out there if you don't need 20% down, and feel free to reach out. I can put you in touch with some solid lenders. That's a whole other topic. So to answer the question, and this is what I said to CBS the other day, and if you can afford the property in the current market, whatever that market is, go ahead and buy it if you want to. Remember that if you can afford the payments now, when interest rates go down, which they inevitably do at some point, it's all cyclical, your payments will go down too when you refinance, which means as other costs go up with inflation, your housing costs will actually decrease. And that kind of holds true even without refinancing, simply because you've locked your mortgage payment cost for the long term, even as other expenses rise with inflation. That's something you don't get when you're renting. Something I say a lot is that you're paying a mortgage either way, just a question of if you're paying your own or somebody else's.